Hello, ladies and gentlemen. Thank you for standing by and taking the time to join us for today's webinar, Internal and External Fraud, Risks and Protection Strategies for Credit Unions. My name is Seda Kemp, and I'll be your moderator. For those of you who may not be familiar with us, CliftonLarsonAllen is a top 10 accounting firm. We are structured to provide clients with professional industry insight by delivering audit, accounting, tax, consulting, and advisory capabilities from industry-specific perspectives. The firm serves more than 350 credit unions in the country, and we have 3,600 staff members, including 200 professionals and 25 partners who focus exclusively on financial institutions. Without further delay, I would like to introduce today's presenters. Tom Danielson is a partner with CliftonLarsonAllen and specializes in providing services to financial institutions. He has nearly 30 years of experience providing audit, tax, and consulting services for community banks and credit unions, and has a wide range of experience with fraud and embezzlement investigations. Randy Romas is a principal in the Information Security Services Group. He specializes in providing IT audits and security assessments for financial institutions. And our third speaker is Pete Storm. He is an information security consultant for CliftonLarsonAllen. He specializes in providing penetration testing, social engineering, and general control reviews for financial institutions. Before I turn it over to our presenters, I'd like to go over today's learning objectives. At the end of the webinar, you'll be able to recognize and understand current risks and trends in internal and external fraud, define and describe key controls to prevent, monitor, and mitigate risks, and implement strategies to combat fraud collaboratively with your employees and members. All right, let's get started with the presentation. Tom, I'll pass the mic over to you to get us started.
Thank you, Seda. I appreciate your introductions, and I truly appreciate everybody that's on the line listening to us today, taking time out of their busy schedules to hear what we have to say about what we're seeing in the world of fraud in the financial institution arena. And without further ado, let's move into our materials. As it relates to fraud, oftentimes we find ourselves in situations where we either forget to look for fraud or simply not alert to it being there. And so today's session, my portion of today's session, is going to concentrate on two or three things. One is simply helping us to become aware and alert to the fact that fraud exists. We're going to learn about what types of things are impacting frauds, and where they are likely to exist in your organization, how to communicate to our supervisory committees and our audit committees about the fact that fraud can occur and actually does occur in the community bank and credit union world. And we're going to talk about some of the steps that are probably most cost-effective in helping us prevent frauds from occurring. And so, without further ado, let's talk about being alert for fraud. And if everybody take just a moment and read this slide. Oftentimes, people will read this and they simply read, "Don't take anything for granted." Even though you probably realize that I didn't put this up here just because it's pretty. Instead, I want to point out that I would suspect that a large number of you actually misread this and didn't realize that it actually says don't take anything for granted. The human mind's a wonderful thing, but at times it misleads us, and it tends to overlook things that are there but shouldn't be there. And so anytime we discover a fraud or somebody discovers a fraud, we step back and we do an assessment. We can't help it. We do an assessment for what went wrong. And invariably, there are a whole bunch of clues that are there. There's a whole bunch of red flags that are there. And we realize it's probably been 6 months, 18 months, up to 5-6 years that there's frauds have occurred within our organization, and we simply didn't see it. And even though there were a lot of clues. And when this happens, I'd like everybody to step back and say, let's not beat ourselves up too much for this, because it's really a challenge for us on a day-to-day basis to remember to look for fraud, and even if we are looking for fraud, realize that the people doing this are trying to hide it from us, and it is not unusual for fraud to go on a long time before we recognize that it was there. There's a group called the Association of Certified Fraud Examiners, and every 2 years they provide a very nice report. They call it the Report to the Nations, about trends that they've seen in the world of fraud and embezzlement over the past 2 years. And so the most recent one that was issued was the 2012 report, which was issued in the first quarter of 2013. And continuing a number of trends, what they discovered and what they've told us is that the banking and financial institution services are the most victimized industry in the country and probably in the world. When a fraud happens in a financial institution, on average, the loss is $232,000, which is way more than we'd like to think that could happen, but in reality, it does happen. But what it also tells us is that good anti-fraud controls, the organizations that took the time and spent the money to put in anti-fraud controls, reduced the losses by a third to a half. And so they are very effective in reducing it. And one of the reasons they're effective is that you tend to catch frauds much more quickly. The frauds actually get detected twice as quickly if there's good anti-fraud controls in place as if there aren't. And we'll talk in a moment about what anti-fraud controls are effective and what we hope to have in place. What control weaknesses contributed to frauds? And today's session is really about awareness, about the kinds of, like I said before, the kinds of things that cause organizations to have frauds, becoming aware of the type of frauds that are being perpetrated in financial institutions right now, the things that we've seen over the past couple of years, and what we can do to correct that. And so the control weaknesses, invariably there are control weaknesses that contributed to the fraud, and the big three are: one is just lack of internal controls to start with, and that's over a third of the embezzlements have a lack of internal controls. And sometimes this is because the credit union is simply too small to have good internal controls, and nobody implemented backup controls or compensating controls to offset those weaknesses. In about a fifth of the frauds that the Association of Certified Fraud Examiners looked at, controls were there, but somebody was allowed to override those existing controls. And so on paper, the credit unions had good controls. However, in practice, somebody had enough power, enough clout, had simply acquired enough control to override those controls. And about a fifth of the cases, management simply wasn't doing their job. They weren't reviewing activity. For example, if there's a step that says if reconciliations are supposed to be reviewed by somebody in management position, either they weren't doing it or they were simply initialing it without actually reviewing it. And so a lack of management review is the third of the big three for internal control weaknesses. Preventing fraud is about caring about tedious matters. There is nothing fun or sexy about talking about internal controls and operating procedures and standardizing operating procedures. In the grand scheme of the kinds of things that we get excited to hear about, internal controls, for the most of us, doesn't rank that high, and sometimes as accountants or internal auditors, we can get kind of worked up about internal controls. But once you get to, say, the supervisory committee or a typical business person that may be helping you out on their supervisory committee, it's very conceivable that their eyes glaze over pretty quickly when you start talking about segregation of duties, and that's just a reality that as people that are interested in preventing fraud, we have to take into account and figure out how, when we make our presentations to these groups, that we can make it interesting. And so, again, sports metaphor. It's about blocking and tackling issues. It's about the glory in football is not what occurs between the offensive and defensive lines. The glory in football is the long pass to the streaking wide receiver. That's fun to watch. But the only reason the long pass is successful is because some offensive linemen did their job to protect the quarterback, and somebody designed the play well to start with. And so, again, preventing fraud is, again, about those blocking and tackling issues that make everything else possible. Who steals from financial institutions? The most common theft is a basic mainline employee, tellers and bookkeepers, people like that, people that are not in a supervisory role. That's 43% of the instances, and that number has remained pretty steady through the years. That it is the mainline employees that are, from a pure number standpoint, are the number one threat. Second threat is the managers, the people one or two steps up from the mainline employees. They're involved in about a third of the thefts. Owners and executives, about 20%, 18% of the thefts are done by owners and executives. And then I haven't figured out how we have another category, but other categories, 4%. I'm not quite sure who's in that category. But the flip side of this coin is, even though employees are the most likely to commit a fraud, when they do, the amount is much more modest, about a $50,000 loss on average. As you move up the hierarchy in the organization, the losses increase as well. So if a manager is stealing from you, they get on average $150,000 before they get caught. If an owner executive is stealing from you, that number climbs to $373,000 before they get caught. So even though they aren't involved with as many thefts, when they do it, they have better opportunity to really damage the organization. When I speak with boards or audit committees about fraud, what I find is, to their credit, supervisory committees and boards of directors and audit committees tend to want to believe that they hire good, honest employees, and really want to believe that those employees won't steal from them. It's audit committees and boards, they know their employees. At least they tend to know their employees. And they want to believe the best. And so one of our first challenges and hurdles when we're talking about fraud is to help our supervisory committees and our audit committees to understand that thefts and embezzlements happen at organizations across the country, regardless of their size, regardless of how honest they think their employees are. And again, you put people under enough pressure, give them enough opportunities, and they will steal from you. It happens. It's a fact of life. So what I found is helpful when I'm speaking with groups about fraud is to actually go through some examples of frauds that have happened in credit unions and banks and other financial services company, and just to make make them aware of how common this really is. And also it gives us an opportunity to look at some individual frauds and say, in my organization, what controls are there that would prevent somebody from doing this exact thing to me? And so the next slides are illustrate how common it is, and we want to pay attention to, again, the title of the perpetrator. Were they a mainline employee? Were they a manager? Were they a board member? How much did they succeed? What scheme did they use? And also think for yourself, what in my organization would prevent this from happening? And so the place I like to go to find embezzlement information is it's a blog that's out there. It's called the Fraud Talk blog, and it's a gentleman who scours newspapers and magazines and reposts information about financial frauds or fraud embezzlement that have occurred across the country. He doesn't concentrate strictly on financial institutions. Instead, he also talks about not-for-profit, dentists, doctors, and frankly, any kind of fraud that happens. What I've done is gone through some fairly recent information and just pulled out the ones that relate to credit unions and banks. And so the first one we'll talk about is Deborah Shaw, believed to be 51 of Marshall County, Mississippi, has been charged with 3 federal counts of embezzlement for allegedly misappropriating $108,000 from the special benefit account for a child that was shot and left for dead in 2006. The account was held at the Merchants and Farmers Bank in Holly Springs, where she was an executive. Court records revealed that she was accused of transferring funds from the benefit account to other accounts she owned or controlled. This one illustrates how sad these happen and how fraudsters pick on the most vulnerable people. And so here we had a beneficiary account for somebody that was of a poor child who was shot. Does that prevent somebody from taking money from them? No. In fact, it may even make it a bigger target. And so she just did a very classic embezzlement where she took money from somebody else's account and put it into her own account, or if she's trying to get away with it for a longer period, put it into another account that she controls that doesn't directly have her name on it. It takes pretty good internal controls to prevent this from happening within your organization. The next one, Nacho Morales, 40, North Philadelphia, Pennsylvania, was in charge with embezzling more than $2.3 million from his federal credit union. He was employed as a manager. He used his ill-gotten gains to purchase 15 kilos of cocaine and real estate. He's been charged with conspiracy to defraud the government, misapplication embezzlement, making false reports on a federal credit institution entries, engaging in monetary transactions, filing false income tax returns, attempted possession with intent to distribute more than 5 kilos of cocaine. This is one bad dude, and it'd be interesting to know if they'd done a background check on him before, or if there were warning signs that this gentleman was involved with the drug trade and things like that. We'll probably never know those details. But to illustrate how serious this can become is this institution, this credit union, actually failed as a result of this loss. Heather Locky, 21, Winifred, West Virginia, been charged with embezzling more than $101,000 from the South Charleston Employees Federal Credit Union, where she was employed. She took the funds from customer accounts, changed the account information in an effort to conceal the thefts. Her boyfriend at the time is also facing similar charges, and this happened over a very short 4-month period. And so when I think about this one, it's again a very similar transaction to some earlier ones where she took money out of somebody's account. But what we're also seeing now is, especially as it relates to electronic check presentment and things like that, people are going in and changing account information and things like that to try and hide it a little better. Moving on, Mirza Birk, 49, Marlborough, Massachusetts, was sentenced to 51 months in federal prison for embezzling more than $2 million from the New England cash dispensing systems, which contracted to manage ATMs for the domestic bank of Cranston, Rhode Island. She and other employees reportedly ordered excess cash for ATM refills and pocketed the difference. Sadly, this is a theft. This is a scheme that is becoming more and more common, where credit unions oftentimes have a pretty good handle on many of their accounts, but in a number of cases, what we've seen is that the ATM clearing accounts and the accounts related to the ATM machines just aren't getting the scrutiny that other accounts get. And on top of that, some of the transactions in these accounts and the amount of activity in the account aren't regular amounts, or the people doing the reconciliation don't truly understand the purpose of the account. And so we have seen a number of them where people have used these ATM clearing accounts to hide significant embezzlements and have used the ATM machines and the refilling of those machines in order to steal a fair amount of money. Probably seen 4 or 5 of these in the past couple of years. Moving on, Jamie Askin, 36, of Troy, Illinois, has been indicted on charges she embezzled more than $104,000 over a 3-year period from St. Louis County Credit Union, St. Louis, Missouri, where she was an employee. Barbara KHG of Bellevue, Minnesota, been charged with embezzling about $1 million from customer CD accounts at Midwest Bank in Marshall, where she was employed. She misappropriated the funds for personal use over a period of 14 years, beginning in 1998. Been charged with 1 count of embezzlement by a bank officer. She and her husband are reportedly owners of a brew house, a restaurant in Lucan, Minnesota, that they purchased in 2008. What intrigues me about this one is, first, $1 million. But secondly, it was a 14-year period that this covered. This one went on and on and on, and we'll never know why the organization didn't catch it earlier. But in some respects, it was only $70,000 per year on average over a 14-year period. It's in some respects fairly modest on a year-to-year basis, but it does accumulate to be a very large number over a 14-year period. And I hope that as we're doing this, you're seeing that these things are not isolated cases, and when we go in and research them, we actually start seeing how common the frauds are, and how many of the cases are actually very, very simple. They're not sophisticated embezzlements. They're taking money from somebody's account and putting it into their own. Sarah Ann Kowalska of Naugatuck, Connecticut, is facing trial for allegedly embezzling $254,000 from the savings and loan where she was employed as a teller. Authorities believe that she transferred funds from 17 bank CD accounts into her teller drawer to cover thefts and to balance her drawer. It is unusual, by the way, for a teller to manage to steal $254,000. The more common number you see from tellers and even head tellers is $50,000 to $80,000. And so I'm trying to figure out how she managed to steal, $250,000 over, and we don't know what time frame this covers. But she was more successful than most tellers in the theft. And again, very common. Just she took money from CD accounts and put it into her drawer. Jennifer Hughes Boyles, 40, Topeka, Kansas, been ordered to pay $712,000 in restitution to Heritage Bank. She pled guilty to bank fraud in connection with her misappropriation of the funds through a fraudulent loan scheme. She was a vice president, and loan schemes are, again, one of the classic embezzlement methods. And since she's a vice president, she had probably more opportunity to steal and managed to get $712,000. This is my favorite. Auberly Price, 46, Southern Georgia, has been charged with embezzling $17 million from a bank where he served as a director. Price, who was being sought by authorities since he disappeared in June, had been entrusted by the bank to invest funds on their behalf, charged with wire fraud in absentia. He may have fled to South America, where he's done mission work and built churches. If you actually do a Google search for Mr. Price, you will find he's on the FBI most wanted list. It is very, very rare that a embezzler makes the most wanted list, and so if you actually go to the website, you will see pictures of him, and the rest of the story here is the bank he was working for in Southern Georgia has subsequently failed. It is believed that he probably committed suicide in the fact he was seen boarding a ferry, and surveillance footage never show him getting off, and he'd threatened to commit suicide. So the expectations or suspicions are that he's actually committed suicide. But the other part that's intriguing about this one and worth noting is that he had spent time building churches and doing mission work in South America. And one of the things when we're involved in preventing fraud in an organization is to realize that a professed strong religious faith is not an indicator that they will not steal from you. And strangely, that embezzlers tend to go to church more often than non-embezzlers. And so simply because somebody claims to have a strong religious affiliation does not by any means mean that we should not think that they are incapable of stealing from us, because that simply is not borne out by the facts. Brenda Smith, 37, Lincoln, Alabama, was sentenced to 20 months in prison for embezzling $129,000 from two customer accounts at Regions Bank. She was a branch manager, covered about a 2-year period. Mary Sheedy, 49, of Morrisonville, Illinois, pled guilty to embezzling more than $60,000 from the Morrison State Bank. She had reportedly stolen $235,000 from 14 customer accounts. She somehow managed to pay back $172,000. Methods. What I like about this one is they give us detail. She forged checks, altered amounts on legitimate withdrawal slips, kept the difference, ran checks through the proof machine a second time after turning off the check number. She admitted she concealed the embezzlement by altering bank customer accounts and deliberately removing other statements from the mail. I find this one intriguing in that it gives us some detail and allows us, again, as somebody that's responsible for stopping thefts, gives us enough detail so we can actually start thinking about, okay, what in my organization prevents each of these individual steps from happening? And it shows how many different places within the organization you may have vulnerability. Our experience over the past 18 months. These are frauds that I have personally been involved with, and there's no doubt that the amount of frauds has picked up in the past couple of years. And the reason that we believe for that is that the economic downturn put more financial pressure on a number of your bank employees or credit union employees, and they started stealing from you. And it's a period of 6 months to 3 to 4 years between when the fraud starts and when it gets detected. And so now over the past couple of years, we are starting to see some of these frauds being detected. And just last night, I had a phone call from somebody where they think a fraud has occurred. They're concerned with about $3 million, although they expect the actual loss to be considerably less than that. But again, somebody having way, way, way too much control by the sound of it. And so we have seen frauds, and they continue to happen, and let's never imagine they can't happen to us. So where have we seen them? we'll talk more about these in a bit. We have seen them in vault cash. We've seen employees stealing money to support struggling family businesses. Like I talked about before, clearing accounts, especially ATM clearing accounts. Employees manipulating ACH transactions on their own accounts so the money doesn't come out of their account. Improper use of the bank's debit card, improper use of the bank's credit card, improper expense reports, loans to family members. Just a little bit of a smattering of what we've seen in the past 18 months. Why did they occur? Again, sort of the big three. Lack of good internal controls, override of existing controls, lack of management review, and what was, in some respects, we get that, we understand it, we hate it, but we understand it. What really hurts is that in a number of cases, people knew about the embezzlement within the organization and didn't say anything. When interviewed about that, they said we feared retribution, or they didn't know who to tell. And so a number of these frauds actually went on longer than they should have because people didn't speak up. Where'd the money go? Some of it went simply to support struggling family businesses. And then it's not that they were trying to put money in their own pocket. They were really just trying to keep their business afloat, although they did put money in their pocket. Sometimes it's used to buy personal goods. One of the embezzlements we looked at, somebody had actually a shopping addiction, and she loved shoes. So we could track the money through the system, and a shocking amount of it went to buy shoes. Simply to support a lifestyle, vacations, nice cars, daughters' weddings, things like that. Gambling and alcohol addictions are a major contributor to fraud. That's why we asked the first polling question about what would you do if you suspected somebody of gambling addiction. Obviously, the right answer is to talk to a supervisor. You shouldn't confront them yourself. You shouldn't keep your mouth closed. However, there's obviously nothing illegal about gambling in most states, assuming they're going to a legal gambling place. And so if we think somebody's got a gambling addiction, we should make other people aware of it. Medical expenses, or people have unexpected medical expenses, and they steal money from their employer in order to cover it. And maybe the one that's caught me a little bit by surprise is how much money was used to support their growing children. Growing children that haven't landed their first job, growing children that have gotten a divorce and gotten themselves financially in over their head, as now they have two households to support on one income. Or put a better way is that it's more expensive to support two households than one, and they simply couldn't adjust their lifestyle accordingly. And then sometimes it's medical expenses of growing children who didn't have health insurance. So that's where generally we've seen the money go to. Again, how do we find frauds? Number one way that frauds are detected is a tip. And it's a tip typically from a customer, an employee, or a vendor. And that's easily, almost 3 times more likely to tip triggers the fraud investigation than anything else. The second most common one is management review. Some alert manager is looking at a reconciliation that simply doesn't make sense. Internal audit catches 14%. Simply stumble upon them by accident, 7%. Account reconciliation, somebody's reconciling an account, and that triggers it. External audit, only 3.3% of frauds are detected by your external auditor. So your external audit is considered to be an excellent deterrent from fraud. It's having an external audit tells your employees that your organization takes financial reporting, takes internal controls seriously, and lets lets them know that somebody is looking at things. And so it's an excellent deterrent. However, it is extremely rare that your external auditor actually detects a fraud. It's very, very rare, so don't over-rely on your external auditor detecting fraud. And then lastly, that at least worthwhile mentioning, notified by the police about 2.6% of the cases. What we find is when the police call you up and say, by the way, there's a theft occurring, that theft is usually very, very large by then. What should we do if we're part of the group that's tasked with preventing frauds? What should we do? First of all is what we're doing today, and that is simply being aware that it happens. We need to be alert that it happens. We have to admit to ourselves that it could be happening in my organization, in our organization. And it could be anybody at any position, from a teller all the way to one of your directors. It just happens. Don't ever pretend it can't happen. So we just have to be aware that it happens. And it can happen by employees, which I think is the most common. At times your customers may be ripping you off, and where that happens is oftentimes in the loan area where they are lying to you about their financial health. Another place it happens is in check kiting, where they're pretending that they have money in their account when they do not. So your customers can do it. Sometimes just outsiders, as Randy and Peter are going to talk about. Sometimes it's organized by somebody like the East European mob. And finally, we have to be aware that sometimes in our organization there might be financial reporting fraud going on, where we have somebody who is lying to the supervisory committee or to management about the health of the organization. Investigated a case just like that in the past year, where the president of a bank got a lot of pressure from board members to reduce the amount of past due loans. Instead of actually calling the customer and taking collection efforts and getting payments or starting foreclosure, instead he simply chose to do file maintenance and change the due date of the next payment so that the loan appeared to be current when in fact it was past due, in some cases 180 or 270 days. Simply manipulated the system and did financial statement fraud in order to make the past due listing look considerably better than it really was. In this case, the bank president put no money in his own pocket. He didn't personally benefit by it, with the exception of I guess continuing to keep his job and reducing the amount of pressure he received from the board of directors. So those things happen. What should we do from a deterrence standpoint, which is way more important than detection? Deterrence. One is, again, like we said before, understand that internal controls matter. They really do matter. And be aware of what weaknesses you have in your internal controls and take them seriously. A very important thing, again, is to implement and follow standard operating procedures and policies. We want your organization to have the attitude of, this is the way we do it. There's one and only one correct way to handle a transaction. And we do not allow anybody, from a teller all the way to the president of the organization, to vary from that. We have controls in place. We expect everyone to follow them. Again, that's the tone at the top, that we have rules, they matter, everyone follows them, and that the supervisory committee, the audit committees, they take internal controls, they take fraud detection and deterrence seriously. They set the appropriate tone at the top. And then we have to listen to the concerns of your internal and external auditors. If your internal and external auditors are saying you've got weaknesses in internal control, you have to have an honest conversation with management about saying, is it cost beneficial to fix it? And we've got very serious considerations to say, is there a way that we can fix the internal controls? If not, what are the weaknesses and what do we have for compensating controls? Or do we simply have to live with a certain amount of risk? Detection. What can we do from detection? Probably the most cost-effective thing you can do from detection is to create a tip hotline. It's discouraging as it may be to understand that 42% of the time you find a fraud, it's going to be from a tip and not from great controls and great procedures. You might as well piggyback on that fact and really encourage tips. And so, creating a tip hotline, they're cheap. It's not expensive to do. It's cost effective. It's an anti-fraud procedure that is really easy to set up. We want to have a no retribution policy for whistleblowers. We have to take this serious. Again, it's tone at the top, and that is if somebody thinks something is wrong, we want to encourage them to make somebody else aware of it so that we can follow up. However, that's only going to happen if the reporting person is not afraid that they will be punished for blowing the whistle. Again, management review. We need to take it seriously. When as a management person, if we're told to review a reconciliation and sign off on it, we actually have to look at it seriously. It can't be simply a perfunctory thing that they do. And then strong internal audit. We want to have good internal auditors that have good technical skills, that have good communication skills, and they have to be supported by the board of directors or supervisory committee. That this group needs to feel that somebody's got their back. If the supervisory committee always supports management when there's a disagreement about whether or not to implement a change in internal controls, if they always support management, pretty soon, being human, your internal auditors are going to quit bringing things up to you because it's really no fun to get shot down every time you bring something up. With that, I am going to end my comments and turn this over to Peter and Randy.
Thanks, Tom. This is Randy Romas. Pete and I are going to move into the area of cyber fraud. And so what we're going to talk about is fraud as it relates to payment systems. There's really two main types of cyber fraud we're seeing in the wild these days. One is related to credit card fraud. The other is related to payment systems. 3 months ago, 3-4 months ago, there was a large grocery chain in the St. Louis area that had a credit card fraud. They had several million sets of credit cards compromised over many, many months. A little over a month and a half ago, the news was a higher-end restaurant chain. Same deal, lots and lots of credit cards compromised. Just today, there was a news flash from another type of retail that had credit card numbers compromised. Today, Pete and I are going to focus on the other area. So we take a look at this slide. What do all these different organizations have in common? We've got a mining company, electrical contractor, a church, rural hospital, healthcare trade association, collection agency, Main Street newspaper stand, a hospice, and on and on and on and on and on. Every one of these on this slide is a company that Pete and I have worked with sometime in the last 6 to 8 months because they have been victim of a cyber attack which resulted in the bad guys draining money out of their accounts. And some of these, the accounts are at banks, some of them are at credit unions. So the moral of the story at the end is everyone is a potential target here. 3 reasons why we should care. When I started doing the security assessment work with the firm 14, 15 years ago, it was one thing for a hacker to be able to break into a business. It was a whole nother matter for them to actually make money at it. And a lot of it was driven by kind of an ego thing. Look at how smart I am. I can do this. I can do that. They can't stop me. Well, in the intervening years, organized crime has figured out a way to make money. And so what has developed over the last several years is a wholesale to retail distribution chain. The hackers break in. They steal account information. They may steal a database with 10,000 records in it. They sell that database off to somebody else in organized crime who starts to parse up the accounts. Says these are credit card accounts, these are bank accounts, and they sell those off to different groups. So the hacker makes money selling it to the first step. The second step parses them out and makes money as they distribute these various account numbers to different groups. Some of those groups will commit online fraud and make money. Some of those groups will take those account numbers and clone them onto fake credit cards and go and buy goods at retail stores and then turn around and fence them. So all along the way, there's a chain here where organized crime can make money. The current threat vector or attack vector is this corporate account takeover. And that's the term that's been in the news. Essentially, the bad guys attack and phish somebody in finance at a business. They compromise their credentials, they compromise their workstation, and essentially the bad guy takes over access into the customer's or the member's bank account or credit union account. And so they perform activities in the financial institution that appear to be legitimate. They appear to be coming from the member or the customer. Most of this is focused on online credentials and access to ACH payments, payroll, etc. Very frequently, we're asked, who would target us? We're a small credit union. We're a small business. The reality is the victims aren't targeted specifically. They're victims of opportunity. And in a few minutes, Pete will go into the specifics of how some of the email phishing works. And the reality is the bad guys have figured out a way to develop and deliver exploit code, and they just wait to see who responds. And we'll touch on that in a minute. This last bullet refers to a Wall Street Journal article where a small business, a guy who's running a newspaper stand in Times Square, just enough to take care of his family. He's got a PC there that reads credit cards, so he can accept payments. And his PC, he falls victim. The bad guys establish malware on his PC and harvest the credit card numbers over time. When they started using those credit card numbers fraudulently, the card brands' fraud detection engines pick it up. They focus in on him, and basically it shut down his business. So this affects everybody, whether it's the credit card fraud or the payment fraud. So what I'm going to do next is I'm going to step through a couple of industry security reports, kind of paint the picture of data that's coming in from some of these fraud reports. Norton Semantic put together a report recently talking about the cost of cyber fraud. And again, Tom's earlier discussion was around insider fraud. That report was coming from the Association of Fraud Examiners. This is solely focused on cyber fraud. And as you read through the report, you look at the summary I brought in here. Essentially, cyber fraud is becoming more lucrative than the global drug trade. Billions of dollars. Organized crime is figuring out how to make money. They're establishing processes. And essentially, the hackers, the organized crime guys, they're going for the easy money. So where's the easy money at? It's small and medium-sized businesses with access to online cash management, ACH for payroll, ACH for accounts payable. They see that the credit union's members are much easier targets than the credit unions themselves. You've been through this for years and years and years. You've got the NCUA showing up doing exams and IT audits. You hire firms to do IT audits and security reviews and penetration testing. most of this activity is moving to where the soft spot is, which is the members and the interface we give them to their accounts. There's an outfit out there called the Ponemon Institute, and this is a security research firm. And over the last, I'd say, 8 to 10 years, on an annual basis, they do a variety of research studies to get a sense for what sort of activities the bad guys are doing and what it costs. And so one of the neat studies they've done each year is the cost per data breach. And it's a nice longitudinal study, so they kind of look at the same things from year to year. And from about 2006 until 2012, the cost per breached record steadily increased up to about $214 in 2012. The 2013 report came out this spring, and for the first time in that period, the number actually dropped. It went from $214 to $194 a record. Now, what that means is when Ponemon Institute looked at these breaches, they tried to put a cost for the entire breach. What does this breach cost the organization over the lifetime of responding to this breach? So let's just use a round number and say the cost is $200 a record. Pete and I had the opportunity to help a financial institution earlier this year who had backup tapes stolen. And those backup tapes essentially were not properly encrypted, and at least one of them contained a full backup of the core system. And so when we looked at it, we determined there were about 20,000 sets of member records on that backup tape that were exposed. 20,000 records, $200 a head. You know, I'm not an accountant. Tom's the accountant. But that number is easy math. That's about $4 million over the lifetime of that breach. That $4 million, that $200 a record, approximately a third of it is hard dollars. So that's the cost to hire and pay for forensic exams. That's the cost to purchase credit monitoring services for the members that are exposed. The cost to change account numbers and issue new cards. Hard dollar costs going out the door. The other 2/3 of the cost are what occur over the long term in man hours to change processes, to update procedures, to pay for increases in insurance and in some of the ways that they do business. So there are some detailed studies, primarily from the Ponemon Institute, that really detail what does it really cost when we have a breach. The other thing they looked at and came out of this was the business banking trust trends. And the bottom line here is the victims, the customers, the members, regardless of how these events occur, they hold the financial institution responsible. They think it's the financial institution's problem and responsibility and not theirs. And so whether we like it or not, that's the reality of the situation we have to deal with. We have to deal with the fact that they perceive this to be the credit union's problem, and the credit union will make them whole no matter how it occurred. The second set of reports I'm going to talk about are analysis of how the bad guys are doing what they're doing. And if any of you have seen me speak in the last year or two, I typically have slides from these. The first is from SANS, the second is from TrustWave, the third is from Verizon Business Services. The SANS report is a one-time study. They essentially looked at and tried to determine how are the bad guys trying to get in from the outside. So they, over the course of a year, they worked with about 9,000 organizations around the world, gathered and monitored traffic coming in from the outside in. What are the bad guys trying to do? They gather that data for a year, they analyze it, they distill it, and they really come down to two key areas. One is client-side vulnerabilities, and the other is vulnerable websites. Client-side vulnerabilities refer to the fact that the bad guys are trying to attack our users and their end workstations, not our infrastructure. So they're not going after the email server, the firewall. even to a degree, they're not attacking the websites per se. Most of the activity is email phishing, trying to convince the user to open a message and do what the message asks. And again, Pete will show an example or two of that coming up. Essentially, they're trying to exploit vulnerabilities in the operating system or the applications that we use on our workstations, the Office products, the Adobe products, the Java products that make our websites very interactive. The attack mechanism is an email. There's a request to visit a website and log in, or visit a website and download something, or open an attachment. So that's where most of the email phishing attack activity is geared. The other thing they determined secondarily was attacks on vulnerable websites. Everybody's got a website now. Most credit unions actually have two. They've got, and that's kind of generically speaking, one website is what we refer to as kind of your marketing site. Who we are, where we are, the services we provide, how to contact us. There's also on that marketing site a link to log in to home banking. That usually links to a different website which houses the portal into member banking, home banking. And we refer to that as a transactional one because that's where the accounts are. That's where, depending on the functionality, maybe we can make credit card payments or we can actually do bill pay. So the bad guys are going after those websites, looking for places to log in, and then trying to guess passwords. If I can guess the administrator password to your marketing website, I can do anything I want to it. I can deface it. I can put up political slogans or hate speech. Those types of attacks get recognized very quickly. Or if I guess the administrator password, I could very subtly change the code somewhere so that the website has an image maybe that has my malware embedded in it. That way, anybody who browses the website, downloading the image, downloads my malware, which tries to attack their workstation, which is right back to a client-side attack. Or I could change the code behind the link from the marketing page to the home banking page. So when they click log in now, instead of going to your home banking site, they go to one that looks just like it, but it's a copy. It's one I put up designed to capture their username and password. The other thing they might do is they might attack what's called the input fields. And those are any of the fields where we input some sort of data and we hit submit. So let's say, for example, I want to sign up for the monthly newsletter to be mailed to my house. I need to go to the page that says sign up here, and then I have to enter my name, my street address, my city, and my zip code. And when I enter those and I hit submit, that information gets pushed back to a back-end database. That back-end database is going to look at the info, the request, it's going to process it, and then it's probably going to issue a command somewhere else to say, hey, Randy wants to get the monthly newsletter, add him to the mailing list. And once that has occurred, the database will return information back to the website that says, thank you, Randy, you've been registered, you will receive the next newsletter. Well, that process, entering data, hitting submit, and having the back-end database process the submitted information can be attacked. If the website and database aren't built, created, developed with secure coding practices in mind, then we can try to attack one of those fields. And the example I'll use is the zip code field. The zip code field, when we enter data there, should only ever have numbers entered, 5 numbers or 5-4. And unless we're from Canada, Canada uses zip codes that have letters in them, but for a zip code field, we can pretty strictly define what legitimate input to that field is. And in secure coding practices, when we build those fields, we want to strictly define the field. So if we don't define that field, we let anything be put in there, we as hackers can try to put in, what I call gobbledygook. We can put in all kinds of characters, different characters, wrong characters. Instead of putting in 5 digits, we could put in 256. And in doing that, in a methodical process, we're trying to see if we can find a place where the database has a hiccup. It gets some unusual data that it doesn't know what to do with, and we can use that hiccup to cause the database to do something it wasn't designed to do. And this is called a SQL injection attack because we're attacking through the website form or input field to the database. If we can find that hiccup or breakpoint, we can usually cause the database to run other commands of our choosing. So we can have the database print to the screen the contents of a particular table, like the member account table or the member address table, or we can have the database run commands in the underlying operating system in an attempt to take over the operating system. So in summary, SANS was looking at outside in, how are the bad guys trying to get in, primarily attacking the users through email phishing to get at the applications on their workstations, secondarily attacking vulnerable websites because they have weak passwords or they have input fields and forms that don't properly sanitize the input. Next, we're going to talk about TrustWave and Verizon Business Services. TrustWave and Verizon actually do what are called breach analysis reports. And in both cases, they're looking at what did the bad guys actually exploit? What allowed them to get in? TrustWave is a managed security services provider. They do a lot in the credit card security space, and they investigate several hundred of these a year. And so every year, TrustWave puts out a breach analysis report. The data I have here is from 2012 because the 2013 report just came out. But again, we get trends from year to year, and they're consistent. One of the key takeaways from TrustWave was that almost 80% of the successful attacks were because of remote access and weak credentials or client-side attacks. So that kind of mirrors some of the SANS data. The majority of the credit unions we work with, and we work with a lot, almost all of them have some form of remote access. Some of them have remote access for staff and management and IT to do their job remotely. Most of them have remote access for a vendor to remote in and service a system. 60% of these breaches are because of that remote access that we present outside and some of the other weaknesses that go along with it. Once the bad guy breaks in, they have to go find the data they want. They have to jump from system to system. They have to elevate their privileges. Once they get to the inside, 80% of that propagation, looking for the data, going to other systems, is because of weak administrative credentials, weak or default passwords on administrator accounts, on the systems we build, on the systems the vendors provide. I refer to this slide as the sky is falling. This comes from TrustWave, and again, they're mostly looking at credit card breaches. In this case, they break it out into two categories. They talk about data at rest and data in transit. When the data, or data stored, when the data is in transit, not stored, all the credit card activity is through payment gateways, and the credit card data doesn't actually sit on any of your systems. So it's all tokenization and payment gateways, and all you get is reconciliation. When the data is stored, it's actually saved somewhere. So it's on a point-of-sale system, it's on a point-of-sale server, back-end server, a processing server, and it's periodically sent out to the payment gateway. That storage can be 5 seconds or 5 minutes. For some period of time, it's stored there. When the data is in transit, not stored, the bad guys are inside for over 100 days before anybody knows it. When the data is stored, the bad guys have a vested interest in staying inside and lurking and being very stealthy about it so they can gather more data. When the data is stored, they're inside for 1.5 years before anybody knows it. So, we talk about Tom's presentation earlier, people not really paying attention, not looking at the right things. A key takeaway here is very often the bad guys are in for a long time, and we don't know it because we're not looking at the right things. And that leads me to my next one. We talk about Verizon. Verizon is similar to TrustWave. It's a breach analysis report. The difference is Verizon has a much larger pool, largely because Verizon works very directly, more so than anybody else, with large national law enforcement. So they work directly with the Secret Service and the FBI, and they tend to work with a lot of the law enforcement agencies from many other countries. So they have a much larger pool to draw from. Whereas I refer to the TrustWave report as the sky is falling, I use Verizon as the silver lining. A couple of key points that come out of this. The first one, the time from successful intrusion, where the bad guy actually breaks in, to leaving with the data can be days, weeks, or even months. Days, weeks, or months where they've broken in, they're rooting around, they're gathering data before they leave with it. Days, weeks, and months that we can recognize, react, and respond, but we're not. Second point, almost all of the time, the log files of the systems have evidence of the breach attempt, the successful breach, the rooting around on the inside and elevating privileges and jumping to other systems, copying the data, and moving the data out. Days, weeks, and months where the logs are being populated, but we're not looking at the right things. Finally, most of these are considered not highly difficult. What do we mean by that? Well, if we go back, not highly difficult, weak default administrative passwords. Most of these, once they get to the inside, are guessing passwords. If it's really just guessing passwords because they're weak, it would be considered a relatively low-effort fix to change and implement better passwords. Okay, well, we're to Pete, and Pete is going to spend a few minutes talking more specifically about how the email phishing attacks work and what some of the keys and telltale signs and things we can do to mitigate that risk are.
Thanks, Randy. It's a pleasure to have the opportunity to be a part of this session. And as Randy noted, for the next part, we're going to look at a common attack that we had discussed briefly, as well as ways that the credit union, as well as the credit union's members, can start implementing controls to mitigate the risk in this area, maybe prevent and detect these types of attacks. And so perhaps one of the most common ways that organizations are compromised from the outside, as it currently stands, is through email phishing attacks. Randy had mentioned that the attackers are moving towards the weak points in an organization, while they're still, targeting your firewall and trying to brute force into your network. The fact is that the attackers are going to explore those methods that are easier for them to exploit. So they're going to test your end users, and let's face it, the organization could have top-notch firewalls, top-notch security from an external perimeter standpoint. However, a lot of the vulnerability resides with the end user. And I'll go with the saying, you're only as strong as your weakest link. Well, in this sense, you're really only as strong as your least aware employee. So all it really takes is one employee to fall for the email phishing attempt, to go visit a link and have their system exploited. And I bet a lot of us have seen a variety of different email phishing attacks, and some of us probably have email phishing emails in our inboxes as we currently speak right now, or in your spam filter. I know I had some this morning. But the adversary is very smart, and they don't craft the email to appear, with skull and crossbones or, a lot of spelling mistakes. While that does occur, they try to make it as real as possible. And in a lot of cases, this is coming from an internal or a trusted resource, internal employee, Some are targeted towards the individual employee, more of like a spear phishing attack where it's actually targeted to that employee. But a lot of the corporate account takeover that we're seeing is related to emails that are kind of taking the shotgun approach, where they've gone out, they've harvested email addresses from a website, and they script out and send the email to everybody. And so next we'll take a look at an example of a real email phishing message that, from the outside, this looks pretty legitimate. Really, it's coming from an internal employee to another internal employee requesting that they go out and update a Microsoft patch. And so at first glance, this doesn't look too weird at all. It comes from Randy Romes. Well, he's an internal employee. However, by taking a more careful look at this, we can start to identify some telltale signs that say, this is maybe not a legitimate email and might warrant further investigation. So the first thing you'll note is in Microsoft Outlook at the top in the From section, it indicates from Randy Romes. Well, this is actually from an internal employee, and so with Microsoft Outlook, you'll also notice that there are brackets that are containing the full email address. In most cases, if this is sent from an internal employee in Microsoft Outlook, you will not see the actual full email address, rromes@larsonallen.com. You'll just see Randy J. Romes. And there's a little bit bigger visual for you. Secondly, the email is asking the user to go out and visit a Microsoft web page. And what you'll notice is it's not taking you to Microsoft.com. It's actually taking you to Microsoft.issgs.net. And a savvy user might recognize that as, hey, that doesn't look like Microsoft's normal website. So taking these two things into consideration, we can see that, or start to determine that, hey, this might not be a legitimate email. Let's warrant some further investigation or inquiry as to, did this really originate with Randall J. Romes? In another example, we just recently did an investigation where a member organization was targeted with a NACHA email, a NACHA phishing email that was sent to about 15 employees. Unfortunately, in this case, one of the business managers had received this email, and it had a link. And so basically it was a hyperlink that said, click here. But if you hover over the link, you can see the actual website that it takes you to. And in the NACHA phishing email case, it took you to www.mfu-time.ru. None of that even comes close to NACHA.org or any sort of official NACHA-looking website. And actually, the .ru would indicate that it's probably a Russian-based website. So we could tell right there that was probably a malicious email. So let's pretend for a second that we actually clicked on the Microsoft.issgs.net link. So here it brings you to a Microsoft download page. And again, at first glance, this looks pretty legitimate. The page looks to appear official. It even gives you the download button. However, here there are a lot fewer telltale signs that this could be a fake website. And so in this instance, maybe you clicked on a hyperlink that said click here, but you can see at the top that it brought you to Microsoft.issgs.net once again. And, at this point, this would be, in this case, the attacker wants you to interact with the website. Some other cases, they're looking for you to maybe test password strength or enter information into a form or sign up for a service or take a survey. In this case, we're downloading a patch. The the goal in all these cases is to have the end user divulge some personal information and hopefully, in the attacker's sense, get remote access to the internal network, or at least remote access to that user system. And so with all these indicators that this is kind of a weird email, a weird website, this would be an appropriate time to give Randy J. Romes a call to say, hey, did you send me this email requesting me to install a Microsoft update? Even before that, usually patches are installed automatically. So having that question in your mind, is this legitimate email? Am I expecting to receive this, or is this weird? And always following up with a phone call to verify its legitimacy. And so this is a very common way that the attackers start out in performing the corporate account takeover fraud. And why is this important to the credit union? Because you go through security training, probably on an annual basis, if not more frequently. You're taking tests. You've been through email phishing assessments. So why does this matter to you? But it's always good as a refresher to keep being aware and keep recognizing these fraudulent emails. On the other hand, too, the member organizations that are utilizing the credit union services and online banking and cash management may have little or no awareness of these types of issues and attacks. And so, with that in mind, the attackers are really looking to take advantage of the weak link. The small to medium-sized organizations that are members, the hackers know that they have money in their online banking accounts, and they also might know that the technical controls and user awareness might be on the weaker side. And this is very prevalent in the industry, across industries. I mean, the first slide was churches, construction organizations, nonprofit, financial institutions. I mean, all industries are experiencing this type of fraud, and really, like it was mentioned, the attackers don't really care who it is as long as there's money in the bank account. I mean, a small to medium-sized business might have a couple $100,000 to over $1 million that they process in payroll on a biweekly basis, and so that's a big chunk of money for these criminals to get their hands on. And you'll see a lot of these types of ACH fraud occurrences. Just go to Google and type in ACH fraud suit, and you'll see a bunch of these pop up, and you can read through and see who else has experienced the same thing. Continuing along, we have a case study which highlights the impact that corporate account takeover had on a Michigan-based metals company. The company experienced $560,000 in fraudulent ACH transfer to a variety of different countries, and the funds, once they were transferred, were withdrawn soon after deposits were made. The company alleges that the bank failed to notice the unusual activity. Well, what is unusual activity? I mean, what does that even mean? Well, in this case, until this fraud had occurred, the customer had only made 2 wire transfers ever. And in just about a 3-hour period of time on the day of the fraud, there were 47 wire transfers requests that were made. And in addition, after the customer became aware of the situation and actually notified the bank to stop transactions, the bank failed to stop 38 more that had also been initiated. And so you can see, as Randy mentioned, finger is going to be pointed toward the financial institution, in this case specifically, to recognize various anomalies that occur within the online banking environment. And so what does a credit union can you do to begin improving controls or enhancing controls in order to prevent or stop these attacks? And this is something that I bet many of us have seen, if not have been actively playing a role in regards to the updated authentication guidance that came out in 2011. I know this isn't new, but actually for some institutions, they are just beginning their risk assessment piece of this implementation. And so, everything starts off with the risk assessment. It says risk assessment, risk assessment, risk assessment, and I'll even say it once more, risk assessment. And it should be noted that the risk assessment isn't just a spreadsheet for compliance, but it really is designed to get the organization as a whole in various business units, identifying where your risk areas reside, where your vulnerabilities may exist, and actively start playing a role in mitigating those risks and closing those vulnerabilities. And the risk assessment should be, ideally this is performed on a periodic or regular basis, but at least annually, at least on an annual basis, the risk assessment should be updated, or after any significant changes have occurred to your organization's environment. Another key thing when consideration of risk and as it relates to the updated Internet authentication guidance is the organization is going to want to identify those external online access points that are high risk, that are typically involved with signing into online banking and performing high-risk transactions that are high dollar value thresholds, which will be determined by the organization. So start defining where those risk points may reside and what the vulnerabilities are and what controls you can implement as an organization to reduce the risk and close up some of those vulnerabilities. And we'll talk about controls in the next couple slides here. The other thing you want to consider as it relates to the risk assessment is, any significant changes in customer functionality. So, for example, if you offer ACH origination and wire transfer functionality via online banking services right now, however, you're looking to offer these services as part of a mobile banking platform, this would be a good time to start assessing risk in those areas. And you want to assess the risk before you implement the functionality. Oftentimes we go to organizations who have Internet banking in place. However, the risk assessment hadn't been performed until all those functions have been in place and operating for months. And the ideal scenario would be to get in front of those and really assess the risk before implementation. Another takeaway from the risk assessment piece would be to, go to Google and look at what other organizations are experiencing as far as security breaches. And you can get in front of that. You don't have to wait until you experience a security breach to assess risks related to another breach. And so some things to consider when crafting your risk assessment. So once you have the risk identified, the organization should start identifying controls that should be put in place to mitigate the risk to those online banking services. And I'll note that there is not a single control that is going to prevent everything. The implementation of a token won't prevent, the corporate account takeover fraud from occurring. Having a layered security approach and adding additional controls to different points in the transaction, whether that be the customer sign-in process, the initiation or approval process, or controls for reviewing those transactions. Continue on with the authentication guidance. The guidance suggests that the implementation of multi-factor and two-factor authentication, and basically multi-factor is the combination of a user ID and password along with security questions, addition to other device identification controls, and two-factor is two things of the three. It's something that you know, like a password. It's something that you have, like a token, or something that you are, like biometrics. And implementing things such as out-of-wallet questions and out-of-band authentication is critical as well to implement in your set of multi-layered controls. Out-of-wallet questions would be those that say, for example, something that you can't find on a bank statement, or if someone loses personal information. So, who was your first prom date, or where was the elementary school that you attended? Another important control is related to administrative functions. What can your member organizations do administratively on their internet banking website? One of the key takeaways here is implementation of dual authorization, offering the functionality for those organizations to have one person initiate an ACH or a wire transfer and the other person approve it. This could go a long way in preventing some of these types of frauds from occurring. And also the implementation of out-of-band verification, having those callbacks when the transaction has been submitted. Another key control here that I see organizations beginning to implement more and more is customer awareness, and this is very critical. We went back to you're only as strong as your weakest link. You're only as secure as your weakest customer, I would say. Having a robust customer awareness program and doing this on a periodic basis is very critical to helping prevent and detect these types of frauds from occurring, because the customer, they use it as a way to pay their payroll, pay their accounts payable. They're not really thinking about network security controls or email phishing. So having a robust customer awareness program can go a long way in helping prevent and detect these types of frauds. And at this point, I will hand it over to Randy, who will continue along with another case study.
Thanks, Pete. So what I'm going to do, I'm going to touch on a couple of case studies. Both of these are ones that Pete or I have been involved in here, and then we'll kind of wrap it up. The first example is from an association. This occurred initially in December of 11. I received a call from the CEO. He was kind of beside himself, and the situation was one where the finance person, I think it was the controller, she comes in the morning and she's got, in his words, 2,000 messages in her inbox, and she's trying to weed through all the spam and get rid of it. And in the process, similar to what Pete described earlier, she clicked on one of the messages, took her to a website, downloaded the malware. So the malware gets on her PC, logs keystrokes, monitors the URL she goes to, and sends that information off to the bad guy. Later that day, the fraudsters, the hackers, make 3 separate ACH transfers all within 30 minutes. The first one was $8,000 to a bank in Houston, followed on about 30-minute intervals by 2 transfers of $540,000 to Romania. We're convinced the first one was a test. Is there money in the account? Can we get it out? Is anybody paying attention? So little over, $1 million goes out here in a 30-minute period. The CEO calls and he's irate. He's beside himself. He's like, and it was a bank. He says, I'm going to sue the bank if they don't take care of this. He was adamant about where the bank failed. He claims when they initially signed up with the bank, a couple years back, he had to fill out forms for wire transfers that only authorized him and his 2 finance people to do wire transfers. He was authorized to do $50,000. His 2 finance people, CFO and controller, were authorized to do $15,000. 2 of those transfers were drastically exceeding those limits. He was also adamant that in the process of completing the control document, he indicated that any transfers he's supposed to receive a callback verification. And he's adamant every time in the past that they have wired money out, he's gotten a callback, and that did not occur here. So, he's on the warpath. He's gonna get the bank to make this whole. I told him, look, Roy, money's gone. It went to Romania. You're not getting it back. So there's a couple of silver linings here. The best one is later that year in June, they caught the bad guys in Romania, and they got all but $6,000 back. Law enforcement is getting better at catching these bad guys. The key takeaway from this one, though, I used to do this inadvertently. When I do the speeches now, I'm very explicit about it. It is very easy to confuse the terms wire transfer and ACH. To our members, the two processes essentially look the same. They do the same thing, and they don't understand the difference. They don't care about the difference. But the reality to us, to the financial institutions, is they are different processes, and there are different controls that go along with them. The CEO was right, and he was wrong. He was right when they initially signed up for the bank. Part of that process was signing up for the wire transfer protocols. These were protocols for in-person or over-the-phone requests for wire transfers. Those controls for dollar limits and callback verification were still in place. The problem was this fraud didn't go out over wire transfer. It went out through ACH. And sometime in the 6 to 8 months preceding this fraud, the association had signed up for the online cash management function, which included ACH payroll and accounts payable. ACH is not wire transfer. There were a different set of controls in the ACH. Most of them were optional, and at the time, the organization chose not to take them on. They did not recognize the difference. They were operating under the assumption, or at least the CEO was, that the same set of controls still applied. So a key takeaway is to, internally at the credit union, look at, do we have different sets of controls? And if so, we need to be very explicit in communicating the differences. And my suggestion is where we can, we should try to make them the same to minimize the confusion. Got to communicate those to the members. The second one is another situation. This one was actually just late last year. The initiating event occurred in August. A hospital got phished. The bad guys wired out the money. The hospital, they notified their financial institution, but they immediately embarked on their own investigation. So they got law enforcement involved. The FBI came in, and guess what the FBI did? They seized the suspect PCs at the hospital, so they just took them and left. They did their analysis, and several weeks later, they bring the computers back to the hospital, but they don't share any information with the hospital. That's just the way the law enforcement tends to work. They gather data, and they hold on to the data because they're trying to prosecute case. So then the hospital goes out and hires an investigative firm because they want to figure out who's at fault here. And so they hire an investigative firm late October, mid-November. Their results come back. And long story short, the investigative firm analyzing the 3 PCs from the hospital says, we don't find any evidence that your data related to the bank accounts left the hospital, compromised at the hospital. Therefore, it's the bank's fault. So the bank, the credit union says, well, we're going to do the right thing, but we want to make sure that's the right thing. So they engaged us to investigate. So there's a big difference here. The hospital's investigative firm only looked at the PCs from the hospital. That's all they had access to. They did not look at the online cash management system, which is hosted for the financial institution. So we did our investigation on the financial institution's hosted site, and what we found was all of the fraudulent transaction activity came in using the right username and password. There were no failed attempts. So the obvious conclusion there is the credentials were compromised at the hospital. Many of the access attempts, logins, actually came from the hospital's IP addresses. The conclusion there is the bad guys had remote control of the PCs at the hospital, and they were routing their traffic through the hospital. So in the end, the hospital's got a report blaming the bank. The bank has a report blaming the hospital. Throughout this process, weeks and weeks and weeks, they're telling us if this goes to court, we're sure we're going to lose. And we're looking at it saying that doesn't make sense. This is very clearly coming out of the hospital. Well, at the end, they organize a phone call between the hospital and the bank for the experts to discuss what each found in the background. And this happens too many times when Pete and I get brought in to do an investigation. We don't ever get the whole story. People think something isn't relevant or they hold something back. And what we find out on this very last call is the hospital asking the bank about the events that occurred 2 days previous to the fraudulent transaction, which nobody told us about. Essentially, 2 days before the fraudulent transaction, somebody at the bank recognized that all 5 of the accounts at the hospital that could log in and do transactions, all of their email addresses were changed by one character. And so somebody at the bank called somebody at the hospital and said, "Did you guys mean to change all your email addresses by one character?" And they said, "No, we didn't do that. It wasn't us." Bank said, "Oh, well, we'll take care of it. We'll switch them all back." Should have been a great, big, huge red flag. The next day, the hospital's in the system getting ready to do something, and they recognize that there's a $40,000 ACH payroll file set up that nobody at the hospital seems to know about. They didn't set it up. So they do a little digging around. They can't figure it out. They call the bank. And in the process of doing that, they must have logged out of the system somehow. But by the time the bank people get on the phone, they go and look and say, "There's no pending payroll file. There's no payroll file that went out. We don't see anything. Must be a mistake. Just ignore it." And so the bank had 2 events leading into this that should have been great, big, huge red flags that they didn't react to. The moral of the story with this one, in my mind, is what we see over and over again once the money's gone. We end up in a very adversarial situation, and we need to get to a point where we're actually working together. And so going back to Pete's part about user education and customer education, member education, we need to use that member education to bring those members back to the table and make sure everybody understands this is something both sides have responsibility for and both sides need to protect against. So kind of finishing up here, many times, if we go back to the security reports, many times there are vendor systems involved. And a lot of times in those cases, our ability to apply controls is largely dependent on the vendor's controls. And so the primary mechanism to make sure those are in place, to monitor them, is through review and enforcement of our contracts and review of the vendor's SSA 16 reports. The SSA 16 is the replacement for the SAS 70s. Finally, many of our clients will actually have us do independent testing of those vendors, even if the 16s are in place. So if we've got hosted banking, hosted internet banking, cash management, if we've got hosted mobile banking, we need to make sure we are reviewing our SLAs, we're obtaining the 16s, and we're verifying that things are operating the way they're supposed to. Last slide, and then I'll do questions. This is in every presentation I do. Every one of these events, all 3 of these areas have weaknesses. The rules, the people, the rules, and the tools. The rules are our standards for how we're going to do business. The people need to know what the rules are and what their role is. When the people know the rules and their role, then the tools can do what they're supposed to do. If our people don't understand that they're not going to be asked to do updates, and they get the email to do the update, they're going to click on the link. And that's going to bypass the controls we have in place. So really, really important that the people understand what the rules are, what their role is. Covered a whole lot of ground here. Key takeaway in this cyber fraud is taking all the things that we as credit unions have done for years and years and years around building our security, managing our security, educating our staff, and turning around and helping our members with the same things. Help them understand how to do risk assessments. Educate them on what the risks are. Educate them on the types of controls we have and the types of controls they need to have to safeguard us from these risks. And with that, I'll open it up to questions.
Yes, thank you to our presenters and our participants. I know we're a few minutes over, but we will stay on the line to answer any questions that you have. Please submit them via the questions function that is located in the upper right-hand side of your screen. Tom and Randy, when you begin to get questions, you can go ahead and start reading them.
I have a question here. Somebody was asking about hotlines and how you go about setting one up. There are actually three options for setting up a tip hotline. One of the options is there simply are vendors out there that will create and monitor a tip hotline for you. And in this case, you simply sign a contract with them, and within your organization, you publicize the phone number in various places, such as your break room, on your internal website. You various times you mention it at your staff meetings, so that your people are aware of it. Some organizations include it on things like customer statements and vendor invoices and things like that, so that people are aware of it. In that case, somebody simply calls it, and then the tip hotline people then report back to you anonymously about what was received. Other organizations simply set up a number and give everybody a number to say the head of the internal audit group, internal audit committee member, or one of the supervisory members that are independent, and say, anytime you have something that concerns you, you may call this number, and your information will be kept very anonymous.
This is Randy. I also have a question here. Some people ask, where can we find resources to help build these member awareness programs? At the end of the questions here, we've got several slides that are more resource slides. Some of them are links to the various articles we talked about. The first 6 or 8 resource slides are actually kind of a rough outline that we've put together to help some of our clients start to build that member security awareness program. So really it's kind of focused on, what do we have to help our members with in terms of enhancing their controls? What are the controls the credit union has that they require? What are the ones that are optional? What are the ones they need to implement themselves? And what are the things they need to consider? So at the end of the slide deck here, there's about 6 or 8 slides that are kind of a broad, high-level outline for what an awareness program like that might look like.
I've got another question that's been posed. Does CliftonLarsonAllen offer a tip hotline service? And I have to sadly tell you that is not a service that we offer. Like I said before, there are other entities out there that do offer that service.
Okay, it doesn't look like we have any additional questions, so we'll go ahead and conclude today's session. If you do have any additional questions that we weren't able to address, or you think of them later, please feel free to contact any of our presenters. Their contact information is on the screen. Thank you again to our presenters and all of our participants. You may now disconnect.